July hiring came in weaker than expected, and the labor market is showing real signs of slowing. Under normal circumstances, that would push mortgage rates lower, but oil is still running the show, and the Middle East situation is overriding everything else. Good afternoon. Last week was a big one, coming off an already packed stretch that included a Fed meeting and inflation data, and then a full slate of jobs reports. The labor market actually came in weaker than expected, which under normal circumstances would have moved the market more than it did. The reason it didn't is the same reason we keep coming back to every week: the complications in the Middle East and what they are doing to oil prices and overriding just about everything else right now. The 10-year Treasury is still sitting stubbornly above 4.6%, and in my opinion, it is probably going to stay there until we see an actual resolution to the Iran war and the Strait of Hormuz flowing at the capacity it was before this all started. Investors have been burned too many times over the past 5 months by rhetoric from both sides that never materialized into anything real. At this point, talk is cheap, and the market has stopped reacting to words. It wants to see action. This week brings more inflation data that will be worth paying close attention to. Let's dive into what took place last week and how it affected mortgage rates. Here are your headlines. Now, one of the biggest surprises that came last week was that July hiring came in well below expectations, with the economy shedding 23,000 jobs compared with forecasts for an 80,000 gain. Payrolls for May and June were also revised lower by a combined 103,000 jobs. Meanwhile, the unemployment rate edged down from 4.2 to 4.1%. This is exactly the kind of report where the headline and the details tell two completely different stories, and I think it is important to slow down and look at what is actually in here. Some Fed officials pointed to a labor market strength as a reason to support a rate hike at their July meeting. With respect, I'm not sure what report they were looking at. Full-time employment dropped 106,000, while part-time employment picked up 138,000, and that is not a strong labor market. That is people taking what they can get. Job losses hit leisure and hospitality, retail trade, and local government education in a meaningful way, and wage growth came in softer than expected across the board. And then there's the unemployment rate, which ticked lower and sounds encouraging until you look at why. A 264,000 drop in the labor force drove that decline. Since May, nearly 1 million people have exited the labor force entirely. When people stop looking for work, they are no longer counted as unemployed, which makes the rate look better than the underlying reality actually is. But we have talked about this before: the continuing claims number and the labor force participation rate tell you a lot more than what is really happening than the headline will ever will. The bottom line is that the report is softer than it is being given credit for, and the Fed members pointing to a labor market strength as a reason to hike need to spend a little bit more time in the details. Now, looking at the private sector and its impact last week, ADP's report reinforced the weak hiring trend seen in the government's jobs report. Private employers added 44,000 jobs in July, well below expectations of about 70,000. Hiring was led primarily by small businesses, while large employers added workers at a slower pace. Employees who changed jobs received an average of 7% pay increase over the past year, compared with 4.4% for workers who stayed with their current employer. We have touched on this before, and July is making the same point again. When you peel back where the hiring is actually happening, education and health services are carrying the bulk of the load. Those sectors driven by long-term demographic trends, an aging population, growing healthcare demand, not by a broad, healthy expansion across the economy. That is a very different signal than seeing widespread hiring across industries, and I think it gets glossed over every single month when people just look at the top line number. Broad-based job growth means businesses across multiple sectors are confident enough in the economic outlook to bring on new people. That is not what this report is showing. What it is showing is that there are a couple demographically driven sectors that are keeping the headline afloat, while most of the rest of the economy is treading water at best. That is worth paying attention to, especially when some Fed members are using this report as justification for a rate hike. Now, job openings fell 7,360,000 in June, and that number may actually be overstated, with some remote positions getting posted across multiple locations, which does inflate the count. The ISM Services employment component fell below 50, signaling contraction. ZipRecruiter called the labor market, quote unquote, subdued in their second quarter earnings report. That is not a word a job platform uses when business is good. Every data point this week is telling the same story from a different angle, and at some point, the cumulative picture matters more than any single report. The Fed members pushing for a rate hike based on labor market strength are going to have a hard time making that case when job openings are missing expectations. Services employment is contracting, and one of the largest job platforms in the country is describing conditions as subdued. The data is not supporting that argument right now, and I think that becomes harder to ignore with each report that comes in. After last week's labor market data, this week shifts the focus back to inflation, and we could not be at a more important moment for it. This morning kicked things off with existing home sales, while Wednesday brings CPI, and Thursday a doubleheader with PPI and the weekly jobless claims update hitting on the same day. Friday wraps it up with retail sales, which will give us a read on whether the consumer is still holding up despite everything they have been navigating this year. CPI on Wednesday is the one I'm watching most closely, with the labor market showing the cracks we've covered this week and oil prices still keeping upward pressure on rates. A cooler inflation reading could be the data point that shifts the conversation at the Fed. A hotter one keeps the rate hike crowd in the driver's seat a little longer. Either way, this week has the potential to move markets in a meaningful way and set the tone heading into the back half of August. I'll be in touch next week with a full breakdown, but for now, have a great rest of your day.